Hey guys, welcome back to another episode of the Finance Hand podcast. And oh my lord, what a week. What a week it's been. You don't even need to be keeping track of finance news to know that it's been one hell of a wild ride due to Trump and his tariffs and the fact that the stock market crashed and then soared again within 24 hours. Your girl has got whiplash just from trying to keep up to date with it. And I thought it would actually be a great time to bring out an episode that I recorded with Beth Saunders from Invest the Rest. Now, I sat down with Beth probably about 2 or 3 weeks ago now, and this was way before all this tariff drama started kicking off. But I think it just shows that the market does tend to follow a pattern. And yes, while we can't predict what will happen in the market, it does have a repeated history and a track record. We also got talking about some alternative commodity investments as well. And if you're not sure what that is, you will shortly. Enjoy the episode, guys. Welcome to the podcast, Beth.
Hi, thank you for having me.
No problem. And we've dressed the same as well.
Yeah.
Awesome. Do you mind just giving a little bit of an introduction as to who you are, what you do, and why I've invited you on the podcast, basically?
Yeah, sure. So I'm Beth. I invest in my spare time, and I basically have been doing it for about 4.5 years since COVID, since lockdown. And I have always wanted to kind of share what I've learned with people. And so I saw these finance creators kind of starting to take off on Instagram. I was like, I could give it a go.
How hard could it be?
Yeah, exactly.
Okay, so you're one of the many people who started investing back in COVID. So can I ask kind of what led you up to that? Is it just that you had spare time on your hands? Had you gone on a finance journey before that? How did that come about?
Yeah, so I had spare time on my hands. I was actually doing a master's at the time that COVID hit, which was great timing. So I suddenly was kind of at home a lot. And I moved back in with my parents at that time, and my dad invests, and he kind of was like, oh, do you want to learn a bit about it? And to be honest, I'd never been interested in it before. I was like, hell no, it's not really for me. It was a real shock that I started to get into it, to be honest. And again, like, it's all those things. Being a woman, I was 24 at the time. It was just like, it felt like that's for you and your friend's dad. Like, of course, I'm not going to be able to understand any of that. And it's taken years, and I'm learning so much all the time. But I had that time in my hands. I started to just take the plunge, really, and I've learned along the way.
Yeah, I bet. I mean, it's interesting that you said as well that, Dad, this is for you and your friends, because I think that's very much what we associate investing with, right? Like, I assume, I'm sorry if your dad is not middle-aged, but do you know what I mean? Middle-aged blokes talking around the table about it. So what was it about those conversations with your dad that made you realise, actually, I can do this? Investing isn't just for the guys in suits that you see on Wall Street or whatever.
Great question. COVID in the markets was a really crazy time. And I think because it was hitting the headlines, I probably saw more about it. I thought, oh gosh, aren't your investments dropping loads, Dad? Is this quite scary? Obviously, COVID was a crazy, scary time for everything. And on top of that, having huge losses that my dad was experiencing in his portfolio, it was obviously conversation around the house. And I was interested as to why he wasn't panicking. I was kind of like, what? Your investments are dropping and you're just fine about it. This feels like you should just sell it, move on, the world's ending. Which it really felt like it was, didn't it? But it hasn't ended. Yeah. But yeah, so I think that it was genuinely him just keeping talking about it. Because especially when I didn't have any of my friends to chat about, I feel like literally in the last few years, more and more women, fortunately, are starting to show an interest. But even back then in 2020, people were like, what the heck? You're into investing now? It's so weird. And I was like, yeah, okay. So it's really down to my dad. Credit to him.
Yeah, nice one. And he sounds like he knows what he's doing with it as well, explaining why it isn't time to panic. And of course, right now in the market, it's having a hot moment right now, to be honest. But my question is, when your dad started teaching you about investing, then what sort of myths and misconceptions did you have about investing? Or was it that you just kind of didn't think that there was a space for you in the investing world?
I think the biggest myth, I guess, is that you need to know everything in order to
Hmm.
start. Still, when I talk to people about that, they're like, "Oh yeah, but you've been doing it so long now, you just know so much, and I know nothing." And I think that genuinely time just doing it. Like I started investing in 2020. It's not like I started learning and then invested. I don't know if that's wise or not, but I have learned that the hard way, and sometimes it's been really good, and lots of times it's not been so good. So it's having the myth that you really need to know it all, just to start. But I think, yeah, over time, I have learned, and you have to do it, because if you try and learn like when you're not actually investing, I don't think you care enough is the
Hmm.
issue. You haven't got that motivation to, okay, I need to like work out what's going on and stay on top of all this.
Yeah, for sure. And I think it's one of those topics as well where you just feel like there's always more to learn. Like you're never going to know absolutely everything. You can learn like a fat lot about
Yeah.
investing, but it's always going to be impossible to learn absolutely everything about it. And you were saying about kind of like you just kind of took the plunge. Do you remember what your first ever investment was?
Yeah, I looked this up, and it was in the summer of 2020. My dad invested in individual companies, so
Hmm.
my introduction to investing was quite hardcore.
Yeah, it is pretty hardcore.
They're pretty volatile, and I've learned to like understand that all a bit better now. It's a company that's still listed, UK small. It's actually a micro cap, so super small, like pottery. They create like nice pottery plates and
Love
bowls
that.
and stuff. And I looked, and I did make a profit on it. So, and I sold
Nice.
it, I think, a year and a half after I bought it. So yeah, that was, I think, luck, rather than skill. But it was a good start. And 2021 was a really good time for the market. So I
Yeah.
actually started investing literally as the rebound from COVID was happening at the end of the summer of 2020.
Hmm.
And then 2021 was an amazing time. So actually I had this kind of false sense of, oh, every day you wake up and all my stocks are up. This is great, but
Hmm.
then 2023 was not like that. And it depends which markets you're invested in, and I'm predominantly invested in UK shares, it's a very different story for US shares. But yeah, it's been, I can't remember how I got onto that. Port Myron, yeah, that was the initial investment.
Yeah, nice one. And just a quick question. What made you kind of invest in that? Is it because you liked the idea of pottery and ceramics, or was it because you did your research and thought, oh, these are good guys to invest in?
I did my research, and yeah, it feels like ages ago now. I sold out of it in 2021, so clearly moved on. But it was, I think, a value opportunity, as in the share price had dropped a lot, and it seemed as if the core value of the company hadn't really changed. So it was an opportunity to just benefit from that price being too low, and it did work out in that instance. It doesn't always work
Yeah.
out, but
Nice. No, you're telling me. I mean, I remember my first ever investment was my friend had the free trade app and she
yeah,
referred me. So I got my like free share, which
yeah,
didn't really amount to anything. But the first one I bought, I literally had no idea what I was doing. So I just put 30 quid in and I was like, oh, M&S, I've heard of M&S. I'm going to invest in them. And if I still, I mean, I kept it because it's like pence in there, but I still get
yeah.
the extra, the odd 4p dividend every now and then.
Oh,
So
there you
love that for me.
go. Yeah.
But it sounds like you had a really smooth entrance into investing. And of course, you had the guidance of your dad helping you out with that. But say, for example, there's somebody who wants to start investing, they might have the same worries that you did before you started investing, that, it's too complex, or it's you've got to be a certain type of person to invest. Where would you start now? Would you go straight for individual stocks? Would you try going into a fund? And then if you could also
Yeah.
just explain a little bit about the difference between those, that would be amazing.
Yeah, of course. I definitely wouldn't go into individual stocks if you've not done it before. It's the highest risk, highest reward type of asset you can buy, which is fantastic if you know what you're doing. And just as an explainer, my dad runs a small investment company and I now work for him, which has been a progression. So I am doing it all the time, basically. So that's why
cool.
It's very cool. That's why I can invest in individual stocks. But I think for the average person, I wouldn't. Passive investing, which is just buying into an index, let's say the S&P 500 or the FTSE 100, they're just tracking the overall market that you're invested in. And those are so great for beginners because they're hands off. You can just watch it. Although recently has been being quite dramatic.
I was going to say, let me just grab my glass of wine for that one, Beth.
Generally speaking, when you zoom out, it's quite a smooth ride up. So I think ETFs, if you are a complete beginner.
Brilliant, yeah. So if you're a beginner, Beth, what ETFs would you look at as a beginner who wanted a fairly passive way of investing and didn't want to go down the individual stocks route?
Yeah, I at the moment own a global ETF. So that actually has quite a high concentration of US stocks in it at the moment. So it's not the most diversified you can possibly get, which is why I've also bought a European market ETF as well, just so that there's proper diversification. Because the issue is, as the US has become higher and higher valued, where ETFs are supposed to be diversified when they're looking at a whole index, because the US has grown so much, it's become a lot larger. And so I think I looked at my global ETF has a 63% US exposure, and that's meant to be a global representation. So actually it's a US representation with a bit of everything else. So that's why I've decided to also buy a European ETF, because Europe and the UK has been maybe not valued as well over the last few years. So I would consider that. And then I actually also have a commodity in physical gold. And I've also got one in physical silver as well, just because the economy in the US is well, Trump is there, and
say no more.
Yeah, and we just don't know what's going on. It's feeling quite uncertain, and when things feel uncertain, if you really want to balance your portfolio, gold and silver historically are a good hedge against markets moving. So as in markets moving down, gold and silver tend to go up. So that's just how I've done it. And
yeah, I mean, I know somebody who's a bit of a like, they're ready for the end of the world, right?
Okay,
and they
yeah.
like these gold bars, and I'm like, this is wild. I feel like I'm in some sort of mafia lair or something like that. I mean, there's not that many. We're talking like a shoebox, but
okay,
you know, still enough. I was like, this feels illegal.
Yeah. Hiding it away, yeah.
Honestly. Yeah. So just going back to diversification then, if you could explain, why is diversification important when you're investing?
Sure. So I think the last month has been a great example of this. There was a lot of hype around the S&P 500, and a lot of beginner investors did kind of pile into the S&P 500, and that's just the US. So diversification means having different countries, having different industries, big companies, small companies, you know, physical assets, commodities, just having a bit of everything, so that if one of those things starts to not do so well, such as the S&P 500, then the rest of your portfolio is there to kind of pick up the slack. For me, I was too heavily invested in the UK, and I was thinking, as I was learning more, so I was thinking, I'm not diversified here, you know, I need to like move more into Europe just to kind of have that spread, so that I can look at my portfolio, and when one area of it isn't doing so well, hopefully the others, pick up the slack.
So say, for example, I'm a beginner investor. I'm like, right, I'm ready to go. I'm going to have a look for a couple of different ETFs, which I don't think we just touched on the definition of that, but just to put it in common man's terms, if you could just put it in super easy terms for us, what an ETF is.
Yeah, so an ETF is an exchange traded fund. So the FTSE 100 is literally tracking 100 companies. So it's like you're getting a basket of tiny piece of 100 companies. S&P 500 is the same, but it's in the US, and it's the 500 largest companies in the US.
Perfect. So getting an ETF and having several, it's almost like double diversification, right? Because you've got all those separate companies, and then you've got all those separate funds that could be spread out across the world. So, say that I'm a beginner investor. I've decided that I'm going to go for a fund based in the UK, a fund based in Asia, in the emerging markets, and then a fund based in the US. So, I've got, for example, 3 funds. Would you say that's pretty diversified?
Yeah, I think so. Yeah.
Perfect. And then my question is, how do I go about actually investing? I mean, of course, there's all these different platforms and there's all these different brokers, and you've got a Wisdom Tree S&P 500 and you've got a Vanguard S&P 500, and then they've all got different things at the end like accumulating and distribution. How do I know where to start?
Sure. It's tough. I think it's called justetf.com. It's a really great website that you can just type in what you want. If you wanted an ESG type of fund in the UK or whatever, you can type that in and it gives you like a list, and it compares certain things. But I guess the key things when you're reading it, because there's lots of words, aren't there, after an ETF. So the first one tends to be Wisdom Tree. That's the company that's offering that ETF. And then there'll be a small fee associated with holding the ETF, and that fee goes to that company. So it's kind of, you're looking for the lowest fee, really, or that's what I do. It makes most sense too. And then it will say what it's tracking. So it will say Wisdom Tree FTSE 100 ETF. And then if it says accumulating, you don't have to do anything. The dividends are just reinvested for you. And distributing, which is DIST is you get paid that income every quarter or every half year, whenever it is that they pay it.
Fantastic. Okay, so when we look at the names of the companies having those ETFs or having those collections of companies, there isn't really a difference in the companies themselves, because you can't lie about the top 100 companies in the UK, right? It is just the provider. Who would you say would benefit the most from accumulating, so the profits going back into the investment, and who was benefiting from distribution and dividends?
Yeah, so it totally depends on what you want from your investments. Generally speaking, if you're young and if you're starting out, and you've got the benefit of hopefully years and years of investing ahead of you, I think accumulating is the way to go, just because, when you're starting out, it's probably like your example of M&S 4p dividend.
Mm-hmm.
It's not really money that you actually are going to have much use for at the moment. But if it continues to just reinvest, obviously compound interest over 20, 30 years could make a huge difference. Whereas if you're taking that money out now, it's nice to have now, but actually, are you really going to use it well now in a way that it would be able to be compounding in the investment? I don't think so. But if you're older or you're wanting to kind of get an income from investing and you have enough invested to warrant that thousands of pounds worth of dividends every year, then sure, go for distributing.
All right. So we've gone through what sort of stocks you can have, whether you invest in individual stocks or funds, what the difference is between accumulating and distribution, and what those tickers mean. Because honestly, you look at it the first time and think, is this even English? I have no idea what this means.
Yeah.
So say, for example, I've got some money and I'm ready to go and invest it. How much can I put in? Is there a limit to how much you can put in? Is there a minimum amount I can put in, or is it super accessible now?
Yeah, it is really accessible now, and all of our brokers are online these days. So you can kind of set up a direct debit for, I don't know what the minimum is, but I think it's something like £25 a month. If you only had that amount to invest, you could start today, just getting it out of your account the second you get paid, so you can't think about it, and prioritizing getting that money in, because the sooner you can start, obviously the sooner you build up a bit of a pot which you can then use. Trading 212 has an account that doesn't have any fees associated with it, which is brilliant. So that might be somewhere to look, or similar to that. And they're more geared towards people who are told ETFs. So if that's for you, I think great, go and look at that. But yeah, you can put in a really small amount, and don't let it being a small amount put you off, because genuinely, like, just start. The sooner you can start, the sooner you'll learn, you'll be more interested in it. You'll be like, oh, my money, instead of going on a nice meal, has gone to my investing account. Like, okay, I'm going to log in, I'm going to see what's going on, I'm going to listen to this podcast, I'm going to, engage with how eventually I'm then going to invest my money. And yeah, I just think that mentality of being able to invest in it, like in your mind, before you're even necessarily actually buying an investment
Mm-hmm.
is really beneficial.
Yeah, for sure. I mean, I know that you just said about kind of checking your account and getting invested yourself in it. And I know everybody says, oh, just put it in. And if you're in it for the long run, invest and then leave it. Don't look at it again. I can't help myself. I just get too excited. Are you the same, or can you leave it?
Yeah, no, I can't leave it at all. No,
No.
no. Those people are mad. No,
I
definitely
agree.
there's something to be said for being able to just forget about it. But the thing I do find a bit frustrating with that is it sounds really easy. It's like, oh, just put it in, and then, if your investments go down, that's fine. But I genuinely think you have to train yourself to be okay with seeing those drops. And it's emotional. That's one of the things that I've learned the most about investing, is how emotional it is. It's all well and good saying, over the long term for investments will do well. And that is true. But in the day to day that your money is dropping in front of your eyes, it's hard. It's really tough. And that's where just being able to be confident and having gone through lots of those in the years I've been doing it, it's that confidence of, okay, every time it has recovered, hasn't it? Yeah, okay, cool. So I can just hold my nerve, sit it out, and hopefully history will repeat itself, which so far it has done. So
Exactly. Yeah. I think it's a really fine balance of being interested, but then when you're seeing those drops, not meddling. Because obviously back in the days of, I keep referencing Wolf of Wall Street, it is my favourite film, to be honest. But like, you'd have to physically call up someone, be put on hold, like, to sell your stocks. Whereas now you can do it in 20 seconds if you want to. So it's just kind of the balance of seeing it, understanding it, but not messing around with it if you've got a strategy in place.
Exactly.
Yeah. Nice one. So, maybe a bit of a controversial one. I'm going for the finance bros a little bit here. But basically, like, the finance bros, they're always, every single day on my feed, on Reels, they're always giving their 2 pence about, oh, this is the latest hot investment, and if you haven't got this, then you've missed out on investing. And even though I've been investing for a little while now, it still sometimes gets to me, and I think, oh God, like, I've missed out on Nvidia or Tesla or whatever. So what are your thoughts on that? Do you believe that there is such thing as missing out when it comes to investment, or do you think it's more about how long you're in the market?
Yeah, again, it totally depends on how you invest. If you're investing in individual things like Tesla, if you'd have bought recently, you'd actually be doing really badly. So there definitely is this hyping up of individual stocks. And then if you are late to the party, sometimes it feels like you just shouldn't even buy it because you've missed it, kind of thing. But if you're investing in ETFs or markets as a whole, I don't think that impacts you so much. So time in the market in that scenario is definitely the right thing. But I also think, just if you've bought Tesla, let's say 4 months ago, and you've suddenly in a significant loss right now, just leaving it isn't necessarily the right thing either, because you have to always be analyzing, why did I buy this? I think Tesla's been shrinking quite a lot in their revenue. So for me, I'm looking at, is the company still strong? Is it still growing? Is it still, profitable, et cetera, et cetera? Are debts still low? And if the answer to those questions is actually no, it's changed, then that might be a reason to sell it. Because if you're in individual stocks, you have to have an investment thesis, and only really selling when that changes. But yeah, if it's in the market as a whole, I think just sit on it. It will, over time, be better than inflation, which is the key thing, really.
Got ya. Okay. But how would one come up with an investment thesis? Is it just kind of looking through the reports and seeing the reason why you believe in a company?
Yeah. It is why you've decided at that moment in time to buy it, and trying to keep a record of that. Because, as I said earlier, emotions are a huge part of investing. And so if you lose sight of your why of buying that company, you can just respond emotionally if you see the share price dropping, if it's been dropping a lot and actually the business is still really strong and there's no real reason for it, which has happened a lot recently because of just the general market malaise.
That's really interesting to hear, because I think a lot of the times at kind of beginner level, you just hear, buy it and hold it. It'll always rebound. In terms of the market as a whole, yes. But if that company is falling because of changes that have happened since you invested, then maybe it's worth selling.
Yeah, I think so, yeah.
Okay, awesome. Thank you for that. Honestly, Beth, I could just chat with you all day about this. You're so knowledgeable on this subject. But just to finish off, I just want to ask you, if you could go back to the time of COVID, you've got your mask on and it's illegal to have a coffee if you're with a friend outside, what are you going to give day one investor Beth a piece of advice? What would you say to her?
I think I would say trust in your research and your methods more, because most of the mistakes I've made have been selling things, as I said, emotionally on a whim. And when I've done loads of research to buy them, and then I don't do the same amount of research to sell it. I just say, oh dear, it's gone down, I'm going to sell it, when that's just an emotional response. And so I think I would say trust that you do know why you've bought that investment and nothing's changed. So just stick with it, stick with a strategy and play it through, and trust that I do actually know what I'm doing would be my biggest piece of advice.
Trust yourself and your choices. Love that. Beth, I've loved having you on the podcast today. Will you come back for another episode with us in the future?
Definitely.
Amazing. Well, Beth, thank you so much for coming today, and we'll see you soon. Thanks for listening to this episode of the Finance Ham podcast. If you like the episode, then make sure to leave me a little review and a cheeky little comment. You can get more on Instagram and TikTok. And if you really liked the episode, you can buy me a coffee on the link in the show notes. Just a quick disclaimer, this podcast is not financial advice and is used for education and entertainment purposes only.